All right, well, welcome everybody. My name is David Leppek, and I'm the moderator of the Surcharging and Cash Discount panel that we're having here today. I want to briefly start making the introductions. On your screen, we have Robert Heinrich from SimPay, Andy Waskey from Aliaswire, John Barrett from Payrock, and Jonathan Razi from Cardex. And again, I'm David Leppek, the moderator of this panel. By way of a high-level introduction on the topic of surcharging and cash discount, this has been a really hot topic over these last 4 or 5 years, but really the surcharging product and capability stems back from a combination of lawsuits that changed some of the card brand rules. In 2004, there was a Walmart lawsuit that was around the topic of honoring the all card rule. That started making some inroads, and eventually there was a 2013 antitrust class action lawsuit where there was a $7 billion settlement between Visa and MasterCard, and in the process of that, for the first time ever, the card brands changed their rules to allow a merchant to pass a surcharge on to their cardholders. There were some conditions around that, and I'm sure the panel will talk to this, but at a real high level, it couldn't exceed more than 4% or the amount that you yourself were being charged as a merchant. There were, at the time, 10 states that had state rules against surcharging, and there was a registration process as well as detailed information around the signage that was required to make sure that the cardholder understood the merchant's policies. As it comes to cash discount, there was actually never any rule against cash discounting, and it was most prominently seen at gas stations where there would be 2 prices published, one for cash and one for paying with credit and or debit. There were also no state requirements around cash discounting. So in 2013, when the card brands made this rule change, that wasn't actually settled until I think it was 2018 when the settlement was all the way through the legal process. But the card brands did make their change as of January 27, 2013, kind of opening the way for a lot of really innovative new products to be designed. And today, as we all see, both surcharging and cash discounting products are really popular because there's obviously a lot of competition and a lot of economic pressures with the recent world as the way it is. So after that high-level description, I'm going to start passing the baton around to our speakers. And the first one on deck is Robert Heinrich from SimPay. Go ahead, Robert.
Thank you, David. I'm going to start off by talking about the difference between cash discounting, surcharging, convenience fees, and service fees. As there are 4 very different programs, each with their set of rules, and we want to make sure we're following the rules, right? So otherwise there's going to be financial consequences with the associations. First off is surcharging. Surcharging is when you're adding a fee to a credit card transaction, and they're naming that fee a surcharge on the receipt. So first off, you can't surcharge debit cards, and you can't surcharge prepaid cards. And the merchants must clearly disclose at the point of sale, as well as the point of entry at their location, that they are surcharging those transactions. The surcharge on those transactions has a cap of 4%. And they cannot surcharge more than what their cost is to accept credit cards. So if their cost to accept credit cards is 3%, they cannot surcharge 4%, making actually money on accepting credit cards. So they must only charge 3%, which is their cost of acceptance. And last, they must notify, which is registering with Visa and MasterCard, at least 30 days before being approved for surcharging. Next one's cash discounting. As David alluded to, cash discounting has been legal forever. And I think it's important to understand what cash discounting is. So an example of a merchant segment that properly implements this is the fuel merchants, right? So when you're going and driving up to the fuel merchants, you're going to see cash price, credit card price. So it's important that it's discounted for paying cash or debit. So you're not discounting the price at the point of sale. You're discounting cash, credit cards. So you're not discounting and then adding a surcharge on top of it. That would be surcharging, right? So again, a model that encourages to add a fee on top of a normal price for being purchased is an immediate discount at the point of sale. That is when the customer is out of compliance. So again, if they're posting a price, discounting it for cash, and then adding a fee, that is surcharging. A discount is clearly defined at the point of sale, what the cash price is and what the credit card price is. Next one I'm going to talk about is a convenience fee. And when a convenience fee can be billed to a cardholder. A convenience fee is a fee that's offered to cardholders to make payments in an alternative payment channel. If you're a card present merchant and your cardholder would rather make a payment online rather than in person, a convenience fee can be added to that transaction. That fee must be a flat or fixed amount. It can't be charged as a percentage of that transaction. All card types, debit and credit, can be billed as fee. So on the surcharging side of things, it was only credit cards that could be surcharged. A convenience fee, you can bill a convenience fee on all debit cards and credit cards. So the convenience fee must be clearly disclosed to the cardholder at checkout to allow them to opt out of the sale. There's no registration needed with the card brands to bill a convenience fee. Like surcharging, obviously you must register with both Visa and MasterCard. So a great example of a merchant who could charge a convenience fee would be like a wholesale distributor with a retail location, where their contractors could be placing orders and paying for those orders over the phone rather than in person. That wholesale distributor could charge a convenience fee on all credit or debit card purchases. Last, I'm going to talk about what a service fee is and when it can be billed to cardholders. Service fees are limited to government and educational merchants. You must register with Visa and MasterCard, just like surcharging, in order to be approved to bill a service fee. It can be billed to card present as well as card not present merchants. A flat or percentage amount can be charged to the cardholder for all cards, whether it's debit or credit. The fee must be clearly disclosed to the cardholder at checkout to allow them to opt out of the sale. And again, there's no registration needed with the card brands. So a great example of a merchant who would charge a service fee would be a school that accepts tuition payments, whether it's online or it's in person. So understanding the 4 different types of fees and when they can be billed is important to building a long and lasting relationships with our merchants. Now I'm going to go ahead and pass it over to Andy.
Hi, good afternoon. Thank you, Robert. As Robert shared, what I'm going to focus on is on the surcharging element. As a electronic bill payment and presentment organization, Aliaswire works with merchants in the B2B environment. We work with merchants in the insurance space, as well as really any other billers or merchants that are sending out a bill or receiving a payment on an account. So more than likely, we're dealing with customers that have more than just a one-time relationship with their payers. It's important, and some of the topics that I'm going to share are effective pricing of the surcharge program, offering alternatives to payers that are paying online, and lastly, keeping up with compliance of association and state rules. So as I had shared, the customers that are utilizing bill payment or electronic bill payment and presentment merchant sites are often return customers making either one-time payments or setting up payments in advance or having a long-term relationship. It's important to note that surcharging, as Robert had shared, cannot be done on a recurring transaction. So you can only bill a surcharge in a one-time environment. The offer of free merchant processing, which oftentimes is used to entice merchants towards a surcharge model, although it is enticing, It is important that billers or merchants look at the overall longevity in the relationship with their payers and make sure that when they are adopting a program, they're doing so in a responsible way. So as Robert had shared, as well as David, you can't charge more than 4% or what the cost is. But many of these merchants are outsourcing, bringing in a third party in order to manage their surcharge program. And in doing so, the cost is oftentimes higher than what that true cost from a merchant processing. So a fee could be upwards of 3.5%. And it is important that as a merchant or as a biller, you're understanding that your customers will not pay online if the fee is too high. So really finding that balance and striking that balance, working closely with your payment technology provider to ensure that you're responsibly administering a surcharge program, that the fee is used to cover the cost of interchange, and that's being reviewed on a periodic basis. Within our organization at Aliaswire, we review the surcharging program and the portfolio on a quarterly basis to ensure that the margins are in line with core merchant pricing, and that the customer's adoption rate is maximized in that surcharge program.
Hey, Andy, can I interrupt you real quick?
Yes.
4% seems like a pretty high percentage amount. When would there ever be a case where the interchange wouldn't be covered by a 4% surcharge, for example?
I don't believe that would ever be the case. The most expensive card would be, I think, tops out at around 3%. So it's my understanding that the association utilized that 4% just to make sure that there was enough of a buffer, but create some guidelines within that program.
Got it. Thank you.
So in addition to effectively pricing that program, it's also important to offer your customers an alternative. So when a customer is going through either the checkout process or the bill payment process, if they're adverse to a surcharge program, being able to offer an ACH, an opt-out towards a cost-free transaction is important for the longevity of the relationship and for the benefit of utilizing that alternative payment channel to get paid faster and more efficiently, and ensure that you're doing the right things for your customers. And then lastly, what I'll share is, as a responsible payment technology company, it is important to educate the merchants that ultimately they are responsible for compliance with both association as well as state laws that govern the surcharge process. So as a responsible organization, we go through a process of educating where surcharges are applicable, how they can be utilized. And lastly, we have built-in technology into the platform where if a customer is paying from a state that does not allow surcharging, that customer is only offered an alternative payment channel. So that would be an ACH only transaction to ensure that that customer is compliant. So those are three topics as it pertains to the surcharge program and how to do so in a responsible way as a payment service provider. I believe John's next.
Yeah, thank you, Andy. And thanks everybody for joining this panel today. So right now you should have a pretty good idea of what surcharging and discounting is and some of the rules and regulations associated with it. I'm going to shift gears a little bit and talk about selling it. And I want to focus in on, if you're an acquirer, why this would be a solution that you really do need to have as part of your sales strategy, where you'd want to focus your time and efforts on it, what are some of the roadblocks you're going to run into, some of the objections you're going to run into, and then some of the lessons that we've learned in doing this for a long time. So let's talk about why it should be part of your strategy. So I think as David pointed out, surcharging's been around for a long time. And in the early days, it didn't really take off all that well for a number of reasons. There was first of all, it was a new concept. People didn't quite understand it. They didn't know what it was. The legal landscape was completely different. There were a lot of states that didn't allow for it. And it was very onerous on the merchant to be able to get themselves compliant and register. So in the years since then, that's changed a lot. The technology's changed, so it's very easy for a merchant to get compliant. The legal landscape, as you've heard, has changed, right? So there's only 4 states now that don't allow for it. And the other thing that's changed is in the last couple of years, I think, we've all seen this, the proliferation of these programs in the marketplace. I mean, you look at any of the industry rags or go to any of the trade shows whenever we can do that again. It was prevalent, right? And it's just all over the place. So it's becoming more and more open. And then if you combine that with the world we're in today, with COVID, pre, post, whatever you want to describe it, you've got situations where merchants are out there, and this is all kinds of merchants, they're struggling just to survive. They're looking for revenue, they're looking to lower expenses. So everybody is more receptive to this type of a solution. And the way to look at it, it is a solution. It is an alternative payment solution that you can offer a merchant in addition to your other payment solutions. It's also a win-win. It's obviously a win for the merchant. It's zero cost on credit, so you can't get much lower than that. But it's also a win for you as the acquirer because the margins in this are generally higher and more consistent than with other pricing alternatives. So there's a lot of reasons to have it as part of your strategy. But as you're looking at it, you say, okay, where am I going to focus my efforts? I'm going to do this in 2 parts, one traditional and then one in our new world. Traditionally, there were verticals that this was more acceptable in. It wasn't generally thought of as a restaurant retail type of a solution. Some of the vertical, there's a lot, but some of them that, a few that we found some success on is the B2B space. I think you heard that in the previous sessions. I mean, this is a large volume, low margin business. A lot of them don't take cards. A lot of them are still doing invoicing, and the 30-day payment. And they don't take it because they don't want to spend the money on it. They got low margins. So they are very receptive to a solution like this. And when they're doing their pricing to their downlines, which, these are distributors and manufacturers, they don't really they're already passing some costs along. They don't have a problem passing these costs along. So that's one good market. The other one is the service industry. So think legal, insurance, auto, tow truck, auto repair, things like that. You've got a relatively closed audience. You've got some of those industries that are already, it's very normal for costs to be passed through. I mean, think about the legal industry, everything's passed through. So you've got some verticals there where it's not an unknown concept to be able to do that. Another one is in the charity and nonprofit space, right? So these folks, they're there to get donations and they need to minimize their expenses. And think about it, if I'm a donator, if I want to donate $100 to my favorite charity, I'm not going to have any concern about donating $103 or $104. So it's a very good market as well. And then one that's kind of obvious, but we all don't think about it too much, is just people that don't take cards. There's still a ton of businesses that don't take cards. And the reason they don't take cards is they don't want to pay for it. So you have a really good solution here where you can tell that merchant, look, offer credit cards because your consumer wants to pay with a credit card, but let them know it's on you. And if you don't want to pay the surcharge, I have other alternatives, debit or check or cash, but at least you're meeting the needs of your customers and providing them an alternate solution. And it's a wide open market there. So those are the verticals that we've kind of seen some traditional success in, but I'm going to argue again that in today's environment, I would just kind of throw that out the window and everybody is a prospect. Like I said, they're trying to survive, right? So that restaurant that 6 months ago would not have talked to us about this or wouldn't have considered it, today's world, they may very well consider it. because they need that solution in order for them to get through this, not only now, but in the very near future. So I would just open up your thought process in terms of who you can sell it to.
Hey, John, I'm curious, sorry to interrupt you, but I'm wondering if you've seen any cases where people just don't want to handle cash in the middle of a pandemic and are open up to taking credit cards now and considering surcharge or other solutions because of it.
Absolutely. That's another good point, that we're getting feedback from some of our distribution channel that they're seeing more and more customers looking to go contactless. They don't want to deal with, they don't even want to have interface with anybody, right?
Hey,
so
we got a coin shortage, and we got killer bees, and we got everything. It's great, right?
Yeah, you got a lot of things that are really conducive to offering up an alternate solution like this. But you're going to still run into some roadblocks or some objections. So, you know, I mean, there's really two main ones. First one is the legality issue. Is it legal? Can I do it? And I think, you know, you've got a couple of things going for you there. First of all, there's a lot of documentation and proof sources that you can use to show your merchants, yes, it is legal except for these 4 states. You also have potentially references within that vertical that are already doing it. They're already doing cash discounting, and maybe they're doing it incorrectly, or they're doing a surcharging. So, you know, your competitors are doing it, which lends some credibility to the solution as well. But I think one of the best things to deal with, to address the legality question, is really go back to compliance. Because if you're offering a truly compliant turnkey solution, and you can demonstrate to that merchant that you're following all the rules that have been laid down by the card brands, you generally overcome any concerns about the legality issue and can I do it. So we really stress the compliance aspect of it in our sales presentations. The other objection is the obvious one, right? It's the customer reaction. Are they, you know, I don't want to upset my customer. Am I going to lose my customer? And the answer there, in a lot of cases, is really, it's all about choice. It's important to remind the merchant, the customer still has a choice. They can pay with a debit card. They can pay with check or cash or, you know, any other alternative payment that they want to pay. They don't have to do it. So they do have a choice. And that's an important way to handle that particular objection. But I would also make note of the fact that with the trends that we've seen and the trends that I think we're going to see, and Jonathan may talk to this a little bit in the future, as this becomes more and more prevalent and more part of the norm, that objection is going to become less and less. And so it'll be something that you can easily can overcome. So last thing I want to go through is really about just a lesson learned. So we've been doing this a long time. When we first did this, you know, we kind of go, okay, well, how tough can this be? I mean, it's free. Credit cards are free. That's great. And so we kind of just threw it out there, and we didn't have a lot of success. And the reason we didn't is a lot of the stuff I just talked about, right? The reps didn't know how to sell it. They didn't know where to sell it. They didn't know how to overcome objections. All those things that came in, it was a more complex sell because of the newness of the concept than we thought it was. So really the lesson we learned, and this is an important thing if you're going to get into this space, is make sure that you have an adequate and complete training of all of your downlines. And the training is not only on the solution, but it's on the compliance aspect, it's on the objection handling side of it, it's on understanding the value and the benefit. And the training needs to go more beyond, just a little bit more beyond just the product and the solution. Part of it is just the overall value and benefit it brings to a merchant, and that's to address the preconceived notions that some people have, the prejudgments that some people have, where they themselves are going, I'm not sure this is the right thing to do, right? And we saw this with the cash advance business years ago. It's like, I don't believe in it. Well, you may not, and it may not be right for you, and it may not be right for everybody, but here's the value and the benefit of the solution and why it is of value to some people that do really need it. And there are a lot more people now that are going to look at it and need it and see value and want to buy it regardless of that. So we don't want our reps saying no for the customer. Let the customer say no to the solution. We implemented that, and I will tell you that, you know, we went from very few sales in our initial days to where today we're all on our new sales, we're probably at around 30% of our new sales are either a form of surcharging or cash discounting as a solution. That gives you an indication of really the trend that's taking place in the market. So in closing, I would just say, if you're an acquirer, I think you're doing yourself a disservice if you do not have something like this as part of your sales strategy. Remember, consider it as an alternative to your other pricing strategies and make it available to everybody as you're talking to it if you're going to want to grow and succeed in the marketplace going forward. So with that, I am going to hand it over to one of the pioneers of this space, and that's Jonathan Razi. Jonathan?
Thank you, John. I appreciate that. And I found all this information very informative so far. So thanks to all of our attendees for joining us today. The place that I thought I would start is just a few words of background on my company and what we do, so you know our perspective on the surcharging space. We are based in Chicago today. That's where Cardex is located. But I founded the company when I was in law school on the East Coast. So that you know my background, I studied business law, and I was always interested in what I would call the intersection of technology and regulation. Turning to the company, I think that's also a good description of what inspired me to start Cardex. In 2013, the card brands introduced the rules we've been discussing that allow businesses to pass on the processing fee they pay to customers who choose credit cards for convenience or rewards. And I looked at that as a regulatory opportunity, and I really had two theses about that moment, I would say. The first thesis was that the economic pain point that this would solve was huge. Processing fees are a $107 billion problem every year here in the USA. The second thesis I had, however, was that the rules in merchant contracts, meaning the requirements to do credit card surcharging, were so lengthy and complex that if you also looked at the numerous and changing state laws on the subject, really no merchant would have the ability to do this themselves. And I think that's really been borne out if you look at the market today. So I thought this made the case for a RegTech solution provider. And we developed a technology solution that automatically complies with all the requirements to do surcharging. So our vision is that merchants ought to have no compliance overhead. And I hope that's helpful in terms of our vantage on the space. The first thing I want to tell you is how we're seeing things now in the context of the pandemic and the economic recovery. Over the last few months, as John was just sharing as well, we've absolutely seen that surcharging is an important tool in uncertain times. Especially early in the pandemic in the verticals we serve, we saw cardholders rely much more heavily on credit cards, both to preserve liquidity as well as to finance their purchases. It's good they had that option to smooth out declines in income, but that movement from ACH or debit to credit also drove up processing costs at a time when many businesses could least afford it. And that's probably the perspective that's even more salient now that we're working on an economic recovery. Merchants that are seeing a more challenging growth environment are telling us it's even more important for them to eliminate expenses, including eliminating their credit card expenses. So surcharging has really found a lot of traction in this moment because it's that perfect middle path. It lets merchants continue to offer the important credit card option that consumers want while also eliminating its cost. And because of that, and additionally, I would say the development of the surcharging market over these last several years, the conversation around surcharging has changed. And I believe we're at an important inflection point. Several years back, I remember this very well, many people were asking, does surcharging have legs? Is this a long-term trend? And now it's much more a consensus that it's here to stay because merchants are using it successfully at scale, customer reception is good, and within the payments industry, there's a lot of demand to sell it because it's high margin and differentiated. And now the question is not, does surcharging have legs, but rather, given that it's here to stay, what does it mean to do surcharging with excellence? And that's the next topic I want to discuss, the main ways that, in my opinion, surcharging products either go right or go wrong. On the one hand, it's a very positive development that when I talk to large acquirers about surcharging and they're considering how to partner, how to respond to demand, they are talking in terms of compliant surcharging. I think a lot of people, and you've heard it today, are bought in that compliance is a very important part of this space, and that's great. In contrast, I've seen some products come to market with what I would describe as a less positive approach, which is to deliberately take a very small scope. They won't register the merchant. They perhaps won't take responsibility for compliance with card brand rules or state laws. They perhaps charge a fee to offset some portion of what the merchant pays in processing costs, but they leave it to the merchant at the end of the month to reconcile which can be very confusing. I don't think that's the right way to go because I have always believed that an excellent solution in this space is one that is turnkey and frictionless. I think that whole surcharging scope should be performed by the technology provider. So what's implicit in that is my belief that when you're thinking about the biggest barriers to entry in surcharging, those are in compliance, IT, and operations. I really believe that you either excel or fall down based on how well you bring surcharging to online payments. It's very key. That's Moto and e-commerce, as well as the strength of your reporting and reconciliation tools. And those pillars are really about making surcharging as easy to do and for our partners as easy to sell as traditional merchant processing. So now that we have a blueprint for what a successful approach to surcharging entails, at least from my point of view, let's talk about the outlook for surcharging going forward. I want to share some predictions for the surcharging space over these next few years. I think you're going to continue to see strong momentum for surcharging for a few reasons. First, the cost of card acceptance will continue rising for merchants, especially with interchange increases planned in 2021. Second, we expect that in traditional merchant services, selling on price in a highly commoditized environment is going to continue resulting in margin compression among acquirers and ISOs. And I'm going to make a bold prediction on the point about margin. I don't believe you're going to see margin compression in the same way in the surcharging space. And that's because I think surcharging is feature competitive rather than price competitive, since the merchant pays zero for credit. Put in another way, they would rather get more features than they would reduce the surcharge rate because they don't pay the surcharge rate. So there are strong reasons to think that surcharging will not be commoditized, and instead, the competitive question is going to be, how are you winning that feature conversation? And finally, the third reason you're going to see continued momentum for surcharging is that the map is getting bigger. When I founded the company, we could serve 40 states with the surcharging model. We're now serving 46 states, some with additional requirements. So of course, pay attention to those. And we're actively engaged with lawmakers and attorneys general in those remaining 4 states. We have a pending regulatory action in one of those states. And while I don't want to say too much about an ongoing action, I do want you all to know that's being worked on, and that's been important to me. To summarize, because merchant costs are going up, payments industry margin is going down, and the map continues to get bigger and bigger, you are going to see a lot more of surcharging over these next few years. And I know my co-panelists and I will be very happy to keep that conversation going with you. So thank you again. And
the
with that,
question's already been asked via chat, and I can't think of anybody better to answer it than you. What are the 4 states that are remaining, and can you talk about some of the 5th and 6th and why they've changed?
Happy to answer. Yeah, Colorado, Connecticut, Kansas, and Massachusetts do not yet permit surcharging. Those are being worked on. New York and Maine have special requirements. So if merchants are going to surcharge in New York and Maine, they have to comply with some additional consumer disclosures, but that's the current lay of the land.
And what about Oklahoma?
Oklahoma currently supports surcharging. I appreciate you asking that question. You know, it was a lot of work. We initiated a process last year that resulted in an official opinion letter from the Attorney General of Oklahoma. So now Oklahoma is supporting surcharging. That's right.
Another question I'm going to ask for the panel was around basically ACH in a card not present environment as a cash substitute. And I'm paraphrasing here, of course, but the other question is when somebody is buying something online, is the surcharge calculated for the card holder or for the merchant? Who would like to answer that?
I can take the ACH. So my understanding of the question is if it's a cash discount or a surcharge, is ACH a reliable alternative? What we've found is when we implement a surcharge program, we implement so with ACH as an option. Again, the ability to offer an alternative is a positive customer service experience. So to my co-panelists, actually all of them, surcharging is a choice. Being able to make it a positive choice with an alternative is important. So we utilize ACH as not necessarily a cash alternative, but an alternative to utilizing the fee.
Got it. One question was whether they think that Visa and MasterCard will make any changes to the regulations and potentially jump into surcharging themselves directly. Would anybody like to try to field that?
I hope not.
Yeah. Robert, I was just going to ask your opinion on that. Do you think the card brands would be making any changes to the rules in the future?
You know, first and foremost, they want to protect their brands, right? That's what they kind of will do, I think, in the future as well. And one thing I'm sure that they're thinking about is, are my cardholders going to get upset about all this surcharging? So changing any rules, I think they'll stay neutral at this point in time. Because again, you have choices now. If somebody has a credit card in their wallet, they've also got a debit card in their wallet. So as a cardholder or as a consumer, all right, if you're going to surcharge on my credit card that I have in my wallet, I got a debit card here and I don't want to pay that surcharge, so I'm going to pay by debit card. So I don't foresee them changing their stance. Now, Jonathan obviously has a little bit probably more insight and works with them directly, and kind of curious to what he has to say.
Well, it's a great question, Robert. You know, I would always emphasize the common ground we have with the brands on the issue of surcharging. First and foremost, they have rules. They want to see it done correctly. So if the merchant chooses a compliant solution, it's guaranteed that they'll be meeting all those requirements in the card brand rules. One of the very important requirements from the card brand perspective is that no fee be charged to debit. So that's a key one. And the second piece, John alluded to this earlier, that I think is a very important interest of the brand that's very aligned with the surcharging trend, is that surcharging is actually expanding the number of places that cards are accepted in the first place. There are many merchants in categories like B2B, wholesale distribution is a great example, professional services. They don't take cards until they have a compliant option to pass on the fees. So with surcharging, they're taking cards for the first time. That's very customer friendly. And that also means entirely new volume for the payment system. And that's a great thing. So those are a few aspects that I would emphasize.
Great. John, there's a question here for you asking if there's an example of the type of features in which case surcharging would become competitive. I think they're basically asking for some of the verticals that you have seen success in.
Sorry, what was the question again, though?
Well, the question's written, give an example of the type of features in which it would become competitive. But the way I'm interpreting the question is maybe more along the lines of when would a merchant in a more traditional landscape before the pandemic be more inclined to take surcharge versus a vertical where they wouldn't?
That's a difficult question to answer because you just never know in any industry who is going to be open to that type of a thing or not. Generally speaking, I would say that in industries where you're not dealing directly with like in a retail or restaurant environment where you're not dealing directly with a ton of consumers who have a lot of options, and where it's not a prevalent type of a practice, you're probably not going to have as much success as you would in industries that have more tight-knit relationships with their downlines or their customers, or where it's currently a practice. I mean, in a lot of those verticals that I talked about, there are examples where I pointed out legal because that's the obvious one, but there's a lot of them where they are passing on certain costs to their customers. And this is no different than them doing that as opposed to, in terms of a cost of business. And they look at it that way. It's a cost of doing business. And it's no different than if I'm charging you for, whatever it might be that I'm passing down the line. So I think that's the distinction, but I'm just telling you, it's getting blurry. So my advice would be, don't say no to anybody, present it as an alternative, and I think you'll be surprised at some of the industries that are being open to it.
I'd like to add a little bit to that as well. I think it's also the merchant themselves are worried about what their competition's doing in their local area. So for instance, if you have a convenience store, you have 4 or 5 of them within a 5-mile radius, what's my competition doing? So as a sales representative, if I can talk to all 4 of them about cash discounting, surcharging, and get them to opt in, they're all doing it. I think they're much more open to that. And you're also going to be able to get all 4 or 5 accounts that are opting in for that particular alternative payment program.
Got it. Well, gentlemen, I see we've just run out of time, and in fact, we're a minute over, but I really appreciate the conversation. I think it's been really exciting, and unless there's anything else from the administrators, I'm going to go ahead and wish everybody a great day.